It's time to spotlight the Dynamic Hypergrowth ETF from Golden Eagle Strategies that was launched last month. Joining us now is Marc Zuccaro, the portfolio manager at Golden Eagle Strategies. Marc, thank you for being with us today. Could you start by just telling us a little bit about the new fund?
Sure. Thank you for having me. The new fund, the Golden Eagle Dynamic Hypergrowth ETF, focuses on companies that are growing their revenues by at least 40% year over year. We focus on that segment because those are the companies that are experiencing explosive revenue growth, and those are the ones that have the likelihood of the most upside for capital appreciation. The fund comprises about 60 stocks normally, and we focused on the world's fastest growing companies in order to capture the price increases.
And so you have hypergrowth in the title. How do you define hypergrowth? What are its characteristics?
Well, the most basic definition is the 40% year-over-year revenue growth that I mentioned before. But that's important because we don't focus on earnings. We don't focus on other fundamentals because earnings can be heavily engineered. The fact that a company is generating 40% sales growth shows that it is indeed a valid business model and that it is increasing very, very rapidly. Now, a lot of these companies are money-losing companies in the sense that they're not generating profits at the moment. However, what's important to know is those companies are reinvesting very heavily back into their operations and should continue to grow in the near term. Now, these companies enter a hypergrowth phase generally very quickly, and we try to capture them as early as possible in the growth curve. And we rebalance the portfolio monthly so that we can reassess which companies are growing quickly and which ones are starting to trickle off in terms of their growth rate.
So as you try to identify the companies quickly, what is your process to identify the companies that you're going to put into the ETF?
We use a quantitative process. It's systematic. We screen for companies, first of all, that are generating the fastest growth. And we focus on that group of companies. Those companies tend to number around 100, 120 companies at any given time on average. And we start to look deeper into those companies to figure out which ones we want to invest in. Now, importantly, we screen out companies that do not have adequate trading volumes, that are not liquid enough in order to qualify for our screens. Because we trade frequently and because we're an active manager, we want to focus on the companies that are growing, that are trading and with good liquidity so that we can enter and exit them as easily as possible with minimum market impact. Now, what's also important is that we focus on companies that are trading around their last new highs. That's important to us because we know those companies have had their concept validated by the market. And it's important to know that those companies very often will go on to make additional new highs.
So this is not a buy the dip scenario. We are not looking for a buying opportunity here. We're looking for the companies that are performing and having a strong market response.
That's correct. This is really a long-term investment play. The important thing about investing in hypergrowth is it's cyclical like any other investment style, but over the long term, we should be able to generate very high returns on the portfolio, but it happens in spurts. Hypergrowth is very rotational, and it happens frequently in one sector or another sector, but we follow the growth where the growth is occurring now. And over the long term, we feel like we can generate outsized capital gains. That's different from existing growth funds out there.
And Marc, as you focus on hypergrowth, how does this offer diversification to investors?
Well, it's interesting. People think about hypergrowth and they think, well, it's just more growth. And that's true to an extent. But when you screen for these companies, it offers a very different group of companies that are attractive to us. Now, if you look at a lot of the growth-oriented funds that are on the market right now, you'll find that under the hood, they have a very high concentration of Magnificent Seven stocks. So they have the super cap tech stocks in there, and they tend to be very tech-heavy because in searching for growth, investors very frequently think that that's where they should be looking. They should be looking for technology stocks. But interestingly, over the past 15 and a half years, our research shows that only 18% of companies that entered a hypergrowth phase were actually tech stocks. So we're finding stocks that are in other sectors that you wouldn't commonly look for growth in. Materials, consumer discretionary, even occasionally utility companies will come through. And that's important because when you have that sort of portfolio, it means that you can bolt it on to existing growth investments without a lot of overlap in stocks. So it gives you growth, but it gives you a different type of growth than you might find in your average technology-oriented fund, or even the triple Qs or spiders, which are essentially tech-heavy indices.
And Mark, when I was doing some research on the fund before our talk, I saw that Golden Eagle says that it's really important seeking to lead the hypergrowth conversation from an education-first perspective. Why does that matter?
Well, first of all, most people don't know this category exists. Hypergrowth was really only defined about 15 years ago in an article by Harvard Business Review, and it was further substantiated by the World Economic Forum in academic research that they did several years later. What we've done is we've taken that academic approach and we've applied it to the investing world, so that what we do now is focusing on companies that are going through this very, very high growth rate. Now, because people typically think of technology and biotech as key features in a growth fund, it's important for us to let people know that there are other ways for growth to be recognized. If you think about 10, even 20 years ago, technology was the real place where people used to look for growth. But times have changed, and all of the products that have been developed by those technology companies, the software as a service platforms, the hardware, the software, have now trickled down into the economy, are being used by regular traditional companies in order to manage their operations. That's allowed companies to scale at rates that have never been seen before. So that gives us a different type of portfolio and a different perspective on investing in growth. And as a result, we are trying to educate people as to how they can get access to these companies and how they can invest in them without investing in companies that they already have exposure to. So we have our most recent website, which is called investinginhypergrowth.com, which highlights the features of our research and explains why hypergrowth is different and why it's a superior investment, we think, to other investments that might be available.
Mark, we appreciate you being with us to talk about this new ETF and also the importance of education in a very fast-growing space here. That's Marc Zuccaro from Golden Eagle Strategies.